for now, let's focus in on the markets and corporates. 11,038 on the Nifty. It's Blue Star that came out with its earnings, and it was a little bit disappointing. The margins have contracted. Revenues have come in higher by just about 4.5%. We've got Mr. B. Thiagarajan. He's the managing director, standing by to tell us a little bit more about the numbers as well as the growth ahead. Good to have you on board. And, previously in Q4, we'd seen a stellar growth, but this quarter not quite matched up. What's the reason? Would it primarily be the slowdown in consumption?
Good morning. Thank you for talking to me. I don't think there was slowdown in consumption at all. Say, for example, room air conditioners, the market growth would have been somewhere around 22%. We ourselves have grown by around 25%. I think the secondary data is also out. We have done well, and we gained market share there. But the numbers, I can imagine it reads as disappointing. It is because of certain cautious and conscious decisions that we had taken. First of all, in the electromechanical project segment, our was preserving cash. We wanted to be very careful during this particular period. We controlled the billings actually. So if you look at, that is reflected in the borrowings figure itself, from around 403 crores in June last year, it came down to 205 crores borrowing. It is surplus cash of 1 crore. That we have executed very well. The order inflow had been good. It is the backlog order book is 2,841 crores. It is around 34% higher than what it was last year. The real reason for a poor performance is basically, I told you, segment 1, we went ahead and controlled the revenue and profit generation. In case of segment 2, we had to migrate to certain new products, state-of-the-art, world-class, first time in India in refrigeration product segment, which contributed significantly in Q4. This particular time, it did not grow at all. In fact, it would have grown negatively by around 25% or so. So the room air conditioner growth offset the growth of the refrigeration products. It was a very conscious decision we had to take. This was the opportune moment for us. But we do not have any concern at this point of a time about the growth or the performance that we have delivered at all. So this is a particular quarter phenomenon. Having said that, whether there is slowdown in the market, order inflow has been healthy. We have to wait and watch how the festival season will go. Then we will realize whether the growth trajectory is going to remain or not. I had stated in the past couple of months, the summer sales, while room air conditioner grew by 25, predominantly it was low-end products. It was not the high-end products. Second reason is the consumer finance touched record 40% of the sales. So there seems to be some liquidity pressure in the market, which will indeed affect us like it affects many other sectors. This is the summary of the performance.
Okay, fair enough. Now, last quarter you had mentioned that you're expecting 5 to 6% margins in the MEP division for FY20. Do you think that you could achieve this in, the current scenario?
Yes, I would maintain segment 1 margin should be in around 5.5%. Segment 2 margin should be anywhere between 9.5 and 10. And segment 3, we had always maintained it should be in the range of around 15%. So margin pressure is no longer there. We have taken quite a few actions last year in redesigning the products. The commodity prices are stable, exchange rate fine. There are minor changes, but we are not worried at all. We are very much comfortable with the margin. In fact, Q1 margin also would have been very high. Basically, what the advertising should have happened in the month of March, it got shifted to April. The winter was continuing, summer set in later. So compared with last year, this particular quarter advertising expenses were around 18 crores higher than last year. That's why, even though the numbers are somewhat disappointing when you read, we are not worried at all. In fact, internally we feel we have done well, and we are confident of what will happen in the coming months.
You just tell us a little bit more about your current product mix and how you see the UCP segment shaping up? Just a quick word here.
Fine. It has got room air conditioners, it has got air coolers, it has got air purifiers, it has got water purifiers, it has got deep freezers, water coolers, bottled water dispensers, and cold rooms. Out of all this, room air conditioners due to summer did exceptionally well. And deep freezers is a very promising business for us. If you take a 6-month period from January, we would have grown more than 28% in the refrigeration products and systems put together. The products are well designed now, in the sense tier 3, 4, 5 markets, aspirational middle class, it will cater to very well. We have products in every price points. We can compete with anyone with the unique features which Blue Star has been offering in order to differentiate itself. So the R&D expenses, we are continuing with that. We had spent close to around 25 crores last year. We will continue to spend that.
All right, we wish you all the best then. Thank you so much for taking time out, sir, and joining in, giving us a view on your quarterly numbers.